Welcome to Montage Services. My name is Scott Wentz, and what we're going to do today is talk a little bit about corporate tax in general. The audience for this program is for organizations that are looking to come to the United States for the first time, want to learn something about corporate tax, or people who are just learning about tax and want to understand a little bit about corporations. First, let's talk about Montage Services. We're a professional service company that is worldwide, and we have offices in San Francisco, Houston, London, Toronto, and Berlin. And we're a group of accountants and tax service providers who know more about some of the topics we'll be discussing. So when an organization has come to the United States for the first time, or a business here in the United States wants to set up, they're often asked, what kind of business do you want to be? Which is an open-ended question because you don't know what exactly they're getting at. The different forms of businesses are usually limited liability corporation, otherwise known as an LLC, an S corporation, a C corporation, or a partnership. Those all can be used for operating a business in the United States. You can also operate in the U.S. without one of these legal forms. But what we're going to talk about today is using a C corporation or a corporate entity. What's unique about a C corporation is that it is a separate legal entity. As such, it forms a ring fence around the operations of that business, and it therefore protects it from other lawsuits that might occur. That is a legal concept, and we're going to focus more primarily on the tax matters for that entity. In general, the most important thing to remember is that there's double taxation by using a C corporation. First, at the level of the company itself, but then once the company makes money, it has cash it wants to distribute to its owners. That cash distribution or dividend distribution may be taxed by the owners. In general, it is taxed by individual owners who, if they're U.S. persons, if they're foreign persons, there might be a withholding tax that would apply on the dividend being distributed. Corporations in the United States pay tax on a marginal basis, depending on the amount of income that they earn. In general, the brackets are very small, so it's very easy to get to the 34% rate. It takes much larger income, $10 million of taxable income, to get to the highest marginal rate of 35%. There's also state tax, which we will talk about in a minute. That can add to the overall tax liability, so the normal accrual rate for taxes in the United States is 40%. Companies have accounting periods, but unique to the United States is that it's up to the owners to determine what is their year. So they can have a calendar year or a fiscal year of any year-end month ending. Also unique to the United States is there's no statutory audit requirement. There is no audit that is required by our government or by our state governments, and usually the audit is only used for purposes of getting bank loans or demonstrating to the owners what is being earned has been earned. Now we're going to get into some particulars about companies. One misnomer is that there's a differential rate between capital gains and ordinary income. Unlike individuals, capital gains in a company are taxed at the normal, ordinary tax rates of the company. And it's punitive to have a capital loss because that capital loss can only be used to offset capital gains and not used to offset ordinary income. Any unused losses can be carried back 3 years or forward 5 years, but after that they expire. Also, it's important to recognize that companies that start up and generate a loss can use that loss for as long as 20 years from the year that it actually was incurred. So as you can imagine, lots of startup businesses invest capital into that company to get the business going. They don't recognize income in that first or second year, but in subsequent periods, they do recognize income, and that loss from those beginning years can be used to offset that income in subsequent periods. A common question for inbound taxpayers is whether or not to set up the company with debt or equity. And again, the United States is very liberal in its approach here, in that we do not have any thin capitalization rules. There is no amount of debt to equity that must be used. So it is possible to have all the inbound investment to be structured as debt, generating interest deductions within the U.S. company. If the debt-equity ratio exceeds 1.5 to 1, there may be a deferral of some of the interest expense deduction, but it's just a deferral. So we often recommend that interest expense or loans be used to capitalize a company. For filing purposes, there is a form for which is used to report the income on an annual basis to the IRS or our government. That is the Form 1120. There is also a requirement to pay quarterly estimated tax payments on each quarter of the year, such that ultimately the taxes that are due are paid in throughout the year. The financial statements, as we mentioned, are not required to be audited. So there is no statutory audit requirement, and therefore the tax rules dictate how the accounting is done for purposes of preparing a tax return. In general, corporations are on a cash basis method of accounting. You may have an accrual that you've put forward for purposes of accruing for warranty reserves or other reserves that may make sense to have on the financial statements, but for taxes, those are going to be backed out unless it is accurate as to what those reserves are for and it's known that they will be paid. We touched on that there are 50 states in the United States, and unfortunately, each state has its own government. As such, there are different rates in each and every state. They all have their own reporting requirements as well. Therefore, a company that does business in a variety of states may need to report in each state and pay a percentage of their overall income into state taxes. That state reporting requirement is based on what we call nexus. Nexus is generally generated through having employees in the state or leasing space in the state or just merely selling goods and services in that state. Each of them have their own rules as to what would create a tax reporting requirement. As mentioned, our group are experts in this, and if you have any questions as to the form of entity or the type or these general matters as it relates to corporate taxes, feel free to reach out to us and we'll get back to you. Now, do we have any questions from the crowd? Yes.
Can you tell me what state is the best place to incorporate?
So the question is, what is the best state to incorporate? And that's a good question in that to set up a company, that company needs to be set up under state law. The most popular is Delaware. Why? Because Delaware has the oldest state law of any of our states, and the lawyers love Delaware because they're very accustomed to it. But other popular states are Wyoming and Nevada because they have the lowest cost of setup. if you're actually doing business in California, it behooves you to set up in California, because if you set up in Delaware, you're still going to have to file in California, and you're going to pay double fees both to the state of Delaware and to California. The Delaware will just be an annual fee because they want your money to have set up there, but California because you're doing business there. So good question. There are lots of different answers to that. Any other questions? All right. Thank you very much.